There is a growing problem in global markets that doesn't announce itself with panic or collapse. It shows up in pricing. Across stocks, housing, bonds, and sovereign debt, prices are no longer responding to separate fundamentals. They are responding to the same assumptions about liquidity, support, and stability. That is the shift most people miss. Individually, overvaluation is familiar. Markets have seen expensive stocks, overheated housing, or stretched debt before. What is unusual about this moment is that those conditions now exist simultaneously, and they move together. This is what the phrase "everything bubble" is trying to describe. Not a claim that every asset is identical, but that diversification has quietly eroded. Different markets are being priced as if they share the same backstop, the same policy response, the same tolerance for risk. For years, that assumption was reinforced. Low interest rates pushed capital outward. Interventions dampened volatility. Each disruption was met with reassurance that stability would be preserved. Over time, price discovery became less about underlying conditions and more about confidence and support. Risk didn't disappear. It accumulated. When multiple asset classes rise on the basis of the same expectations, the system becomes tightly coupled. Pressure no longer disperses. It transfers. Stress in one area doesn't stay contained. It migrates. That's what makes this structure fragile. It doesn't require a dramatic trigger to break. It doesn't depend on a single failure or a specific event. When prices are calibrated to perfection across the system, even modest deviations can force broad adjustment. The margin for error doesn't shrink in one market. It shrinks everywhere at once. This isn't about predicting a date or forecasting a single outcome. It's about recognizing that the system is now priced in a way that leaves very little room for disappointment. And once that room is gone, outcomes tend to converge. When people hear the phrase, "everything bubble," they usually focus on the word bubble. That's the mistake. The danger is not that assets are expensive. It's that they are expensive for the same reasons, and therefore vulnerable to the same pressures. Stocks, bonds, housing, and government debt are meant to offset each other. When one becomes stretched, capital is supposed to rotate. Risk is supposed to disperse. That dispersion is what gives the system resilience. That mechanism has weakened. Over time, different markets began responding to the same set of forces. Low interest rates, persistent liquidity, policy intervention, the expectation that instability would be managed rather than absorbed. These inputs did not elevate one asset class in isolation. They aligned them. As a result, pricing across the system became increasingly correlated. Assets that once moved independently began reacting to the same signals, the same flows, and the same policy sensitivity. Diversification didn't disappear visibly, it thinned. This is where the structure becomes fragile. When assets depend on the same conditions, stress no longer finds release valves. Pressure doesn't dissipate. It transfers. A disruption in one area forces adjustment elsewhere. Not because the fundamentals are shared, but because the positioning is. The system can still look stable under these conditions. Volatility can remain low. Prices can hold, but that stability is conditional. It relies on assumptions that are not unlimited, about liquidity availability, policy capacity, and tolerance for intervention. When those assumptions are tested, markets don't adjust sequentially. They adjust in parallel. That is the defining risk of the everything bubble. Not excess alone, but synchronization. Not overvaluation by itself, but overvaluation tied together through the same dependencies. Once those dependencies dominate, the system becomes efficient in calm periods and brittle when conditions change. Revised. When people try to make sense of the current risk, they almost always reach for the same comparison. They say, "This feels like 2008. That comparison is understandable and incomplete. In 2008, the damage was severe, but it was concentrated. The failure originated in a specific part of the system: housing, credit derivatives, and highly leveraged financial institutions. Other markets were pulled in after the fact. This time, the exposure is not localized. It is embedded across the entire system from the start. In 2008, Government bonds acted as a stabilizer. Capital fled risk and moved into safety. Interest rates fell sharply, allowing bond prices to rise and absorb pressure from other markets. That release valve mattered. Today, that valve is largely gone. Bond markets are no longer positioned to offset stress elsewhere. Yields are higher, debt levels are larger, and price sensitivity to rate changes has increased. Instead of absorbing shocks, bonds now transmit them. Housing tells a similar story. Before 2008, housing was the epicenter of excess. Today, housing is expensive in a different way. Higher rates have pushed affordability to historic lows. Refinancing risk has increased, and price sensitivity to even small rate changes has intensified. Rather than cushioning the system, housing now amplifies pressure through affordability and financing channels. Equities, too, are different. In 2008, stock valuations collapsed because earnings collapsed. Today, valuations are vulnerable even without a sharp earnings decline. When prices are built on long-term assumptions about growth, liquidity, and support, modest disappointments can force large adjustments. What connects all of this is breadth. In 2008, stress spread outward from a core failure. Now, stress is already distributed. Multiple asset classes are exposed simultaneously, and they are exposed to the same constraints. Tools that once isolated damage now face trade-offs. Supporting one area increasingly destabilizes another. That is what makes this environment fundamentally different, not necessarily more violent, but structurally resistant to containment. There is no single market to isolate, no clear boundary to reinforce, no obvious intervention that resolves pressure in one place without shifting it elsewhere. The risk is not that history repeats exactly. It's that the system has absorbed the lessons of 2008 and applied them everywhere at once. At the center of this structure sits a constraint most people underestimate: debt. Not just how much of it exists, but how dependent the system has become on its continued expansion. Over the past decade, debt was not merely accumulated, it was normalized. Governments borrowed to stabilize economies. Corporations borrowed to fund growth and buy back shares. Households borrowed to maintain living standards in a low-rate environment. As long as rates stayed low, this arrangement appeared sustainable. That condition no longer holds. Rising rates do not just slow borrowing. They change the math of the entire system. Servicing costs increase. Refinancing becomes more expensive. The margin for policy error narrows quickly. This is where the trap forms. In previous cycles, policymakers had room to respond. Rates could be cut aggressively. Balance sheets could expand without immediate consequence. Debt levels were high, but manageable relative to growth and inflation. Today, that flexibility is limited. Lowering rates risks reigniting inflation. Expanding balance sheets risks undermining currency stability. Fiscal expansion collides with already elevated deficits and political resistance. Each option carries a cost that did not exist at the same scale before. This does not mean policy tools are gone. It means they are constrained. Intervention no longer acts as a clean stabilizer. Supporting one part of the system increasingly destabilizes another. Relief becomes conditional, delayed, or partial. Markets sense this shift. Confidence is no longer based on certainty of response, but on speculation about tolerance. How much inflation will be allowed? How much currency weakness is acceptable? How much debt expansion can be absorbed before credibility erodes? Those questions do not have fixed answers. And because they do not, risk pricing becomes unstable. When people imagine a market breakdown, they usually picture a moment, a headline, a shock, a single event that flips the switch. That expectation is misleading. Systems like this rarely fail because of one dramatic trigger. They fail because pressure accumulates quietly until normal functions stop working the way people expect them to. In highly leveraged, tightly connected markets, fragility doesn't announce itself. It builds beneath the surface, masked by stability. That's the danger here. The current system does not require a crisis to begin unraveling. It only requires conditions to drift slightly away from what prices assume. Slower growth, higher refinancing costs, a policy response that arrives later or weaker than expected. None of those are catastrophic on their own, but they don't need to be. When assets are priced on shared assumptions, small deviations propagate quickly. A modest disappointment in one area forces reassessment elsewhere. Capital adjusts not because something breaks, but because confidence in continuity weakens. This is how triggers actually work in complex systems. They are not causes. They are thresholds. The trigger is not an event. It is the moment when expectations can no longer be maintained. At that point, markets do not wait for confirmation. They reprice in anticipation. Liquidity thins. Volatility rises. Risk models adjust. What looks like overreaction is often delayed recognition. Importantly, this process does not unfold evenly. Some markets adjust first, others lag. But once the adjustment begins, the idea that stability will return on its own loses credibility. Participants stop assuming the system will self-correct without cost. That is when behavior changes. Hedging increases. Exposure is reduced. Liquidity becomes more valuable than return. These are not emotional decisions. They are rational responses to a narrowing margin for error. The absence of a clear trigger often makes this phase harder to recognize. People keep waiting for the headline. By the time it arrives, the adjustment is already underway. Once adjustment begins in one part of the system, it does not stay contained. It spreads through structure. Modern markets are tightly connected by design. Assets are linked through portfolios, benchmarks, derivatives, and risk frameworks that respond automatically to price movement. When one market shifts, those connections activate. This is the cascade. It starts quietly. Prices decline modestly. Volatility increases. That increase triggers risk controls across funds and institutions. Exposure is reduced, not because anyone panics, but because rules require it. Those reductions apply pressure elsewhere. Selling in equities affects index weightings. Index changes affect passive flows. Passive outflows force additional selling. What began as a valuation adjustment becomes a flow-driven process. At the same time, bond markets react. Rising volatility and changing rate expectations alter bond pricing. Losses in fixed income reduce the ability of portfolios to offset equity declines. Instead of cushioning the move, bonds contribute to it. Derivatives amplify the process. As prices move, hedging activity increases. Dealers adjust positions to remain neutral. That adjustment adds supply during declines and demand during rallies, increasing the speed and magnitude of moves. Liquidity begins to thin. As bid-ask spreads widen and depth declines, smaller trades produce larger price changes. Market behavior becomes less about information and more about positioning. Price movement itself becomes the signal. This is the critical transition. Markets stop responding to news and start responding to their own motion. At this stage, causality blurs. Selling creates volatility. Volatility forces selling. Risk models align. Independent strategies begin acting in the same direction at the same time. What looks like panic is often automation. Importantly, this cascade does not require a collapse in fundamentals. Earnings can remain positive. Economic data can remain mixed. The process is driven by constraints, not headlines. Once the cascade is active, it does not reverse easily. Stabilization requires time, reduced leverage, and repriced expectations. Until those conditions are met, volatility remains elevated and recovery attempts struggle to hold. This is how localized stress becomes systemic movement. Not through fear, through structure. One of the most common questions people ask at this stage is also the wrong one. When will it happen? The system does not provide that answer. Complex financial structures do not fail on schedules. They adjust when pressure exceeds tolerance, and tolerance is not observable in advance. It shifts with policy, behavior, and expectations. That is why timing is unknowable. Markets can remain stretched longer than logic suggests. Assumptions can hold past reasonable limits. Intervention can arrive just in time, or just late enough to change the outcome. That uncertainty is not a flaw in the analysis. It is part of the risk. The absence of a clear timeline does not mean the structure is stable. It means stress is accumulating without a visible countdown. The danger comes from mistaking uncertainty for safety. What can be assessed as exposure? When asset prices depend on uninterrupted conditions, the margin for surprise narrows. When multiple markets rely on the same assumptions, the cost of being wrong increases. When leverage and correlation rise together, adjustment becomes nonlinear. These are not forecasts. They are properties of the system. The risk is not that something happens suddenly. The risk is that it happens before recognition catches up. By the time timing becomes obvious, positioning has already shifted. Liquidity has already thinned. Volatility has already changed behavior. The opportunity to respond gradually is gone. This is why waiting for clarity is itself a decision. Not an active one, but a structural one. Markets don't reward certainty-seeking in environments like this. They respond to changes in constraint, not comfort. The adjustment arrives when assumptions are no longer tolerated, not when consensus agrees. That is what makes this phase uncomfortable. There is no signal that feels definitive, no moment that feels like confirmation. Only a narrowing set of outcomes as flexibility disappears. Timing will always be debated. Risk will not. What matters most about this period is not whether markets fall sharply or grind lower. It's that the assumptions that supported the last cycle no longer operate freely. For years, stability was reinforced by the belief that intervention could always arrive in time, that liquidity could always be expanded, and that risk could be managed without consequence. Those beliefs shaped behavior across markets, institutions, and policy. They're now being tested simultaneously. This does not mean collapse is guaranteed. Systems do not break on command. But it does mean the margin for error has narrowed to a degree most participants are not accustomed to navigating. The environment has shifted from one of expansion to one of constraint. In that environment, outcomes converge. Price matters again. Liquidity matters again. Correlation matters again. What once felt abstract becomes immediate. Not because fear takes over, but because structure reasserts itself. This is not a story about the end of markets. It is a story about the end of a particular set of assumptions. The belief that risk could be distributed without cost. The belief that policy could neutralize every shock. The belief that time alone would resolve imbalance. Those beliefs were not irrational. They were contextual, and context change. What follows this phase will not be defined by a single event or a dramatic moment. It will be defined by adjustment, slower, broader, and less forgiving than what came before. Not because people failed to see it coming, but because systems built for one set of conditions are always slow to adapt when those conditions disappear. This moment does not demand prediction. It demands recognition. Recognition that the system is no longer priced for resilience. And that from here forward, outcomes will be shaped less by expectation and more by constraint. Silence often follows that realization. Not panic, not relief, just adjustment. Just adjustment.